Hello, hello, hello. This is Matt Williamson coming to you for SensaMarket, bringing you a trade idea. This time we are going to be looking at Apples. We're starting here on our dashboard, chock full of information, but we are going to go over to their trade tab on Apple. First things first, we'll take a quick look at the daily chart here. So pretty precipitous drop as with the rest of the market. We've had a couple of trending days, not trending day, a couple of up days here to offset some of the down move, but obviously not nearly enough to make a dent in the downside. So we're not going to bet up or down. We're actually going to bet on some sideways consolidation for a few days. So typically with this kind of pattern, you will see a continuation lower. This is a bull or a bearish flag rather, so we can paint this on the chart here. We have our big old flagpole, and then we have, in this case, a pretty small flag kind of happening here. And what you would expect, again, is a little bit more consolidation here, and then a second leg lower. Okay, so that's the price action that we would expect to see based on sort of technicals. But what we're going to do is we're going to try to capitalize on the fact that there's supposed to be, and generally is, a period of sideways consolidation here. So we are going to put on a market neutral trade called a butterfly. All right, if you're a newer options trader, then this may be a little complex for you. So hang with me. Okay, we are going to do the following. We're going to sell a put vertical spread, and we're going to sell a call vertical spread. Okay, so we're going to sell both vertical spreads, keeping us market neutral. So let's go over to the option chain here and take a look. So we are going to do this in the 3-day to expiration, or 2-day, I suppose, in this case. So 2-day to expiration, we're going to use the 212.50s. We're going to use the at the money option. So we will sell the 212.50. We will sell the 212.50. All right, so we're selling both the call and the put at 212.50. Okay, in a sense, this is the trade. Okay, we are selling at the money premium with the idea or with the expectation that the market, in this case Apple, goes nowhere. Okay, we collect somewhere in the neighborhood of $3.10 plus $2.74. Let's call it $6. Okay, we're collecting around $6, which means that, you know, as long as Apple does not move plus or minus $6, this trade is profitable in 2 days. Okay. However, this would entail selling naked options. We don't want to do that. We are not in the business of selling naked options. So we are going to cover ourselves by buying 1 strike or 2 strikes out. This is kind of trader's choice. We're going to use 2 strikes. Okay. So we're going to buy that put 2 strikes away, and we're going to buy this call 2 strikes away. Okay. And this gives us our, it's actually an iron butterfly is what it's called. All right, iron butterfly, similar to an iron condor, except we share the short strikes. Call and put are the same short strike. Okay, so in theory, we could lose the entire 2-point spread here since we have sold a put spread. We can lose that whole 2 points, and we can lose 2 points over here, but we can't lose them both. Okay, we can't lose on both sides because they are offsetting to one another. All right, so let's go ahead and plug that in and see what we get on the graph. We get a trade that looks like this. I'm going to take the standard deviation off. This is sort of a shaded curve back here. So we're going to take that off and just look at things like so. This is the expiration graph, okay, with butterflies. Usually we don't really look at the expiration graph, but in this case, we are going to use the expiration graph since we're talking about a trade that expires in 2 days and since our bet is predicated on Apple staying in a certain range. Okay, so this is how the trade looks. Here's our prices on the bottom. So Apple prices 212, 213, etc., and then our P&L over here on the left on the y-axis. So if at expiration we are sitting right at 212.50, we stand to make about $355, $358, something like that. Okay, if we are anywhere left or below, I should say, 209, we're going to lose money. If we are anywhere above 216, we are going to lose money. Okay, this is a theta positive trade, or plus 20 theta, which means we make roughly $20 a day on our on our trade. And the risk here is $131 on both sides. So we're making $20 on 131 in risk. Not too bad. Worth pointing out though, the theta does change as we move along. So it's going to be higher on some days than at expiration. Okay. And it's a gamma negative trade, which means our profit and loss goes in the wrong direction regardless of which way we go. So our losses accelerate to a certain point and our profits decelerate to a certain point. In this kind of trade, it's not super important to look at gamma. Really, you want to look at theta. There's really not any vega exposure. Rho is essentially nothing at this point. Delta is going to flip and flop around as you move through the strikes in the butterfly. Your trade becomes bearish over here, or sorry, bullish over here and bearish over here. So we're gonna get a little flip-flop as we move further on in. And one really important point here is that the trade does not look like that until expiration. Okay, trade looks like this today. Okay, so not a lot of profit over there. If you do happen to make it a day without anything happening, then you'll make, about 30 bucks or so. On Thursday, you're doing better at that point. Now you're making 80 bucks again on your risk of 113. That's not a bad return really. And then if you can hold it all the way to Friday, that's where you actually see the return. So in this case, this is going to be a full-on expiration hold. Just make sure you do close it prior to expiration. Okay, if you close it, or if you don't close it prior to expiration, you wind up with the risk of being assigned on one of those short options or one of those spreads. If you're all the way out of the money, then you will not see any additional risk. But if you're halfway in the money, if you're in the money with a short, but not a long, you can be assigned and run into issues. You don't want to wake up on Monday morning being long or short 100 shares of anything that you didn't mean to. So make sure you close this at or before, let's call it before. Make sure you close this before expiration. Okay. But again, this is a hold it till Friday, close it before expiration. Don't get out early. Size this appropriately so that you can afford to take a full $131 risk for hit rather. Okay, if you're trading too large and you're finding yourself jumping out of this thing early, then again, that's an indication that your position size need to be smaller. So size this sucker as if you were going to lose 131. Do not go into this trade thinking, what if I win $350 or what if I could win $250? Go into the trade thinking, all right, I could lose 131 bucks. I'm going to make that bet. Okay. All right, so that's going to be it. Our credit that we're looking for in this case, around 370. In this case, your strike width, which is 5 points, minus the credit is your risk. Okay, so if you were to take in like a $4.50 credit here, your risk would be 50 cents. If you were to take in a $4.99 credit, your risk would be 1 cent. Okay, if this thing is trading for a $2 credit tomorrow, then your risk is $3, not 131, or $1.31, I should say. All right, so we'll leave it there. Again, hold to expiration is the trade plan on this one. And make sure you do close it prior to expiration. All right, don't hold it through expiration, hold it to expiration. Quick caveat, nothing in this video was meant to be or should be construed as financial advice. Trade at your own risk. Don't do it stupidly. Be smart about it and responsible about it. All right, take care. Happy trading. We will see you in the next one. Bye-bye.